Good morning, everyone. I would like to thank Governor King for this kind invitation to speak to the Bank of Korea International Conference. The topic of this conference is very special to the BIS. We have paid close attention to global liquidity in the past few years, and we have tried to contribute it to the international efforts to understand this difficult concept better, and this includes a number of reports and analysis that we have done, starting with the early work that was done by Jean-Pierre Landau, who is with us, and he did an excellent job, and also with the other G20 groups. And now the BIS is asked to report to the G20 on global liquidity spillovers. The Bank of Korea has contributed actively to this work, and Governor Kim in particular has reminded us all many times in many meetings of the importance of this issue and of the importance of the close international cooperation among central banks on this topic. I shall start my remarks with some brief words on the concept of global liquidity and some of the reasons why it's important to monitor it. And then I will try to characterize today's global financial conditions. I will mention the stubbornly high levels of debt in the advanced economies and the still rising levels of debt in some emerging markets and in some advanced economies. I shall review quantity and price indicators of global liquidity. Finally, I shall turn to the unprecedented levels of monetary accommodation and the challenges that the desirable interest rate normalization could pose. With regard to policy, I will make three brief remarks. First, in most of the advanced economies hit by the crisis, banks, households, and firms need to redouble the efforts to deleverage. They need to continue with the process and to repair their balance sheets, while policymakers must redouble their efforts to enact far-reaching reforms. Crucially, progress with repairs and reforms would allow central banks to normalize monetary policy in a manner that is consistent with a return to sustainable and balanced growth. The second suggestion would be that there are late-cycle risks in some of the emerging economies and some of the advanced economies, those that were less affected by the crisis. These economies have been experiencing credit booms, and in these cases, authorities should continue to augment these macroprudential policies adopted to date in order to make the financial system more resilient. And my third general comment will be that policymakers need to strengthen prudential policies that are able to anticipate and to meet the challenges posed by the inevitable and, most importantly, desirable normalization of global interest rates. So let me start with global liquidity. Is a very elusive concept used in a variety of ways, and any rigorous analysis of it is very challenging. Given the current focus of my words, which will be financial stability, I would like to define it here as simply ease of financing in the international financial system. And despite its conceptual difficulties, we think that global liquidity is worth monitoring for at least two main reasons. First, experience shows that endogenous buildup of financial vulnerabilities may take long time, may be difficult to predict, but at some point of time, systemic liquidity stress can emerge very quickly and threaten the stability of the global financial system. This kind of dynamics point to the need to monitor global conditions and, most importantly, to be ready to take decisions even under uncertainty. Uncertainty in a very complex system, the very complex system that we live in. Waiting for irrefutable evidence may prove quite costly. Central banks, to be sure, play an important role in the generation of global liquidity, but ultimately, easing of financing reflects the ability and the willingness of market participants to provide funding or to trade in securities markets. In turn, their ability and willingness are determined by private perceptions of risk, by risk appetite, as well by broader economic and financial conditions. That was the first reason. The second reason is while global conditions matter for domestic policy making, domestic policy decisions influence global conditions. And we at the BIS remain convinced that policymakers should take into account how their domestic policies affect global conditions as well as the feedback effects thereof. Easy financial conditions can show up in many ways, in rapid growth of credit, extended under weak underwriting standards. Excessive risk-taking and rapid credit growth can weaken the financial system through lower credit quality, as well through excessive leverage, maturity transformation, and currency mismatches. But it can also show up, particularly after a balance sheet crisis or during a balance sheet crisis, can show up in less deleveraging and less repair than usually happens after this kind of situations. Proper analysis of global liquidity, therefore, will require monitoring a variety of different indicators, and these will include prices and quantities. These will include stocks and flows at both domestic and international level. So let me move now to the present situation. In order to characterize the global financial conditions, let me start with credit stocks and flows. Overall, we see a particular differentiated picture. It's a simultaneous, slow deleveraging and releveraging or leveraging up in other areas. This is a combination of different trends. The first is stock measures indicate that outstanding levels of both domestic and international debt, public and private, are overall substantially above the pre-crisis levels in every region. If we take the G20 countries, most of the G20 countries, the increase of total debt has been more than 30%, which is around more than 30 trillion more debt now than at the beginning of the crisis in these countries. Second, in terms of growth, bank credit growth is slow now or negative in Europe and growing modestly in the United States, but it is showing a strong growth within countries less affected by the crisis, such as in Asia or Latin America. Third point would be growth in foreign currency credit. That means credit, for example, in dollars, but outside of the United States, or in euros outside of the Eurozone. And the international bank credit, cross-border credit, point to a more expansionary condition in some regions. And finally, global bond markets have been very dynamic at historically low yields, and the outstanding stock of non-financial corporate bonds in international markets has increased sharply since the beginning of 2012. Let me give you a few more details on these points. 5 years after the onset of the crisis, households and firms in the economies most affected have adjusted their balance sheet less than one would have expected, given the experience of previous crises. The exception is United States. There, the household sector has delivered through paydowns, write-offs, and income growth. As a result, the ratio of household debt to disposable income or to GDP in the United States has fallen back to levels of the early 2000s, and the ratio of overall private debt to GDP has improved. Of course, the other side of the coin is that public debt has increased significantly higher than the reduction on the private debt. In Europe, countries that experienced property and credit booms, such as the United Kingdom or Spain, have had some deleveraging in their household debt. However, when we consider private debt and we consider overall Europe, debt has barely fallen in relation to GDP. And again, here, the public debt continues to rise. So all in all, despite an unprecedented easing of monetary policy and despite fiscal deficits historically high, balance sheet repair by the private sector lags. Let's move to Asia. In emerging Asia, on average, private credit in relation to GDP remains well below the levels in advanced economies, as you can see, but it is trending towards the peak reached before the Asian financial crisis of the late 90s. At the same time, real estate markets have shown strong price gains in a number of economies of the region. As a result, policymakers in some Asian economies may face what we call the risks of financial strains associated with the later stages of the financial cycle. At this point, credit and price gains slow down and even reverse. So our conclusion is that policymakers in the region should perhaps do more. They have been leaning against such late cycle risks. In many cases, they have used macroprudential policies. Nevertheless, they will be well advised to use the present conditions, current conditions, to continue to make their financial systems more resilient. So let me now complete this rapid picture with the other trends that I mentioned at the outset. Foreign currency credit in dollars and euro outside of these regions are growing, are growing to residents out of residents of the rest of the world. In the case of the United States, the accommodative monetary policy has been associated with, I would say, a very gradual recovery in credit within United States. Meanwhile, dollar credit to non-US residents have been growing at a relatively rapid pace. Now it totals $7 trillion. That is 13% of the GDP of the world ex-United States, and its growth reached a high of almost 20% in 2011, fell back in 2012, but is now moving up again and is at 10% in the latest data, and that's the chart on the right side on the top, is the red line. And you can see the contrast with credit, the blue line within United States, dollars credit growth outside of United States. If we move to the Eurozone, growth has resumed this credit to business and households outside of the Euro area, currently at about 15%. The rate is even faster than the dollar outside of United States growth. However, the outstanding amount of foreign euro credit currently is 2.5 trillion, which is a little bit less than the other one. So if we move now to the international bank credit, aggregate international bank credit to both banks and non-banks has stopped growing or even has gone negative, as the deleveraging of banks have been more intense in the cross-border component. By sector, the shrinkage of the international bank credit is concentrated in the interbank market, and geographically, it reflects mainly the weakness in credit growth to Europe and to some extent to the United States. By contrast, bank credit to Asia and Latin America has grown more strongly, and as a result, the weakness in aggregate international bank credit does not indicate global tight financial conditions. I'm sorry, I have a lot of charts now. You will not have time to understand, but I think the story is very clear. You can have a look at the charts. Let me mention the dynamism now of global bond markets. This is the market where the global ease of finance perhaps is more evident. The return of equity and bond volatility to the low levels, pre-crisis levels, has supported the demand for credit risk in bond markets. Risk appetite has returned to pre-crisis levels. Corporate and emerging market bond yields are low, although spreads are not yet reached the pre-crisis lows. Non-investment grade, first-time sovereign issuers have been having a lot of demands, have seen bids for bond issues 10 times the issuance amount, so really big demand. And outstanding emerging market corporate bonds are growing quite rapidly. Similarly, major economies have seen outflows into equities and bonds of emerging markets, and sometimes strong. You can see that there are some volatility in these flows. So let me now have, we have been talking about the credits, stocks and flows. Let me move now to some monetary indicators. Monetary indicators point to unusual policy accommodation amid still a weak and uncertain economic outlook. By lowering policy rates to near zero and expanding their balance sheets, central banks in the major economies have bid up bond prices and pushed the corresponding yields well below levels implied by the expected short-term rates. As a result, the price conditions for risk-taking and for private liquidity generation are largely in place. For their part, central banks in emerging market economies have followed a different path. They raised policy rates in 10-11 as global trade recovered and inflationary pressures became evident. But starting later half of 2012, they have been lowering their policy rates, and as a result, not only short-term rates are substantially negative in real terms in the advanced economies, but they are also about zero or in some cases negative in emerging economies. The major central banks, I think we are all familiar with this, have also hugely expanded their balance sheets. Central banks of the advanced economy hold assets that have risen from about 4 trillion before the crisis to 10 trillion now. However, broad money has grown slowly. In other words, the money multiplier in major advanced economies has collapsed, as it happened in Japan in the early 2000s. The large-scale bond purchases by major central banks have helped to push nominal bonds yields down to the relative to the prospective nominal GDP. This gap is very striking for advanced economies, and it has widened for emerging market economies. Perhaps what I would like to underline is more that to appreciate how unusual global bond market pricing is, we can have a look now at the term premium. This requires a little bit of calculations, but I think everybody would agree that today there is a substantial negative term premium in major bond markets. What this suggests is that given central bank removal of bonds from private hands, the term premium, that is the extra reward for bearing the price risk and inflation risk of holding these bonds, has flipped into a penalty. It has flipped into this negative premium that is investors must pay for having this risk. What this means is that the exit from the current accommodative monetary policy stance poses challenges in two dimensions, at least two dimensions. The first is the familiar one of managing expectations of policy rate setting. When will rates start to rise? How fast they will rise? How will the rate of the rise depend on macroeconomic conditions? That's the normal kind of question. The other perhaps is more unfamiliar and is the managing this term premium situation as central banks signal any change of policy in relation to their purchase or sales bond duration, removing bond duration from their own portfolio. So I could say that the very success of pushing the term premium down into negative territory has created the risk of its sudden rise, even if central banks succeed in communicating properly their intended paths for short-term policy rates. And of course, a global steepening of yield curves could hit the capital of financial institutions and could substantially worsen the debt sustainability in public finance. I think all of this underscores the importance both for market participants and also for the authorities of being prepared for an eventual exit from the extraordinary accommodative global monetary conditions. While central banks surely have all the tools necessary to technically engineer an exit and will doubtless do their utmost to communicate properly with market participants, and they have improved communication significantly, it cannot be taken for granted that the process will be smooth. In fact, there is a lot of dependence on these low rates at this very moment in budgets and markets. So let me finish and summarize and draw some policy implications. I know all this is an oversimplification and there is significant differences from country to country, but let me say that overall the stock of international and domestic credit remains high, implying that the leveraging, particularly the leveraging in the private sector, certainly even more in the public sector that continues to relever, but the leveraging in the private sector is not yet complete in the major advanced economies that were most affected by the crisis. And at the same time, there is increasing leverage in other advanced economies, those less affected, and in emerging market economies that suggest that some vulnerabilities are being built in these regions. At the same time, indicators of financing conditions and risk appetite are pointing to increased risk-taking in some markets, while the unprecedented monetary easing had some difficulty in boosting broader money and bank lending in the domestic economies that they were targeting. It has increased foreign currency credit in dollars and euro to non-residents and pushed down yields in the global market to the point that investors are paying a term premium rather than receiving this term premium. The global ease of finance is perhaps more evident in the global bond market. Those are markets where volatility has been compressed to pre-crisis level, risk appetite has returned, sovereign and corporate bond yields have reached record low levels, lending conditions have been weakened, outstanding emerging market corporate bonds have grown rapidly, and portfolio capital flows have at times been quite strong. In terms of policy, let me repeat the three general suggestions. First, private sector deleveraging and balance sheet repair needs to continue in crisis-affected economies, and in these areas, policymakers need to press on with the structural reforms. Balance sheet recessions are special, and more action on these fronts is required for a balanced recovery. Moreover, these actions would allow central banks to normalize monetary policy in a manner that is consistent with a return to sustainable and balanced growth. The second suggestion is in emerging economies, and again, those advanced economies that have seen some rapid credit and were less affected, that the financial cycle may be reaching critical stages. Policymakers and market participants in these countries can use the current conditions to continue to focus on making the financial system more resilient. And finally, and more broadly, authorities and market participants must recognize the challenges inherent in the inevitable and desirable interest rate normalization and seek to make their financial firms and markets resilient in the face of potential strains. Thank you very much for your attention.